to Up, how to tap into your unlimited potential for self-directed trading and how to avoid the mistakes that can blow up your account. This is a masterclass offered by My Wealth School. It is one of a number of classes that we already have available or will be rolling out over the next few weeks and months. And we are glad that you're here. This class will be taught by both myself and my husband, Michael. For those of you who do not know me well, prior to engaging in coaching and consulting full-time, I spent 20 plus years as a licensed professional in the financial services industry. Michael is a retired estate planning attorney who also taught for many years as a college professor and also taught adult continuing education. This masterclass is being presented over 4 sessions. Session 1 today is an introduction to this topic. In session 2, we are going to look at perhaps the single most important and yet overlooked key to successful trading, your mindset. Session 3, we will look at components and the building blocks of a successful trading plan. And session 4 will be all about implementation. We will have a full Q&A class where together we can examine the steps in more detail and how to put them in place as you craft your individual plan. And now, with session 1, I am going to turn the class over to Michael, who will introduce you to Up.
Thank you, Ann, and thanks to all who are attending, whether you're here live today or you're watching a replay. As we introduce this topic, we look at the old American middle class. The middle class is losing ground, and it really has been for a number of years. And after more than 4 decades of serving as the nation's economic majority and really the engine of growth, the American middle class is now shrinking in size. Sadly, most of those leaving this station are headed down rather than up the income and wealth ladder. Is this you? Have you watched your social strata sink into the abyss over the past few years because of a job loss or other calamity? Perhaps you've gotten accustomed to the new gig economy, where the 40-hour-a-week regular job with benefits has gone to the wayside in favor of a contract, perhaps with more hours, less pay, no benefits. How's that working for you? Or you might be retired and find yourself alarmed at the return you're receiving from bank deposits, treasury notes and bonds, money market funds. Again, I ask, how's that working for you? And over the last decade and a half, the overall attitude towards investing and trading has shifted. What's caused this? Well, in our view, it's due to the 2 market collapses we've seen since the start of the millennium. And in fact, there are other corrections, as we are well aware, that are also ongoing from time to time. But if we look back basically over the last couple of decades, since 2000, the number of Americans that own securities hasn't so much fallen as it has plummeted. In fact, according to a recent survey, little more than half of Americans own stock, whereas in 2007 it was over 65%. Add to this the decrease to below 50% in the ownership of IRAs, 401ks, and 403bs and thrift savings accounts. And what's happening here? We're plummeting backwards. The reality is this: as the markets moved from, let's say, the 2009 lows through multiple years of a bull market into early 2020 and new all-time highs, actually more and more investors, number-wise, exited. And there's still fewer entering the market, despite the fact that savvy traders can make money whether the market's going up or down. Well, why is this happening, you might ask? Well, of the people between 18 and 29 years old, only about a quarter of them invest. They're the least likely of any group to participate in the markets. Why? Well, maybe they have debts, student loans, credit cards, starting up, their new lives. Perhaps they have a mistrust of the financial industry as a result of the meltdown in the mid-2000s. Maybe it's because of a lack of financial literacy. But wait, there's really more. According to a report from Pew Research, the top 10% of the earners in this country control 80% of the stocks and mutual funds. And for the top income earners, stock ownership's more than 93%. That's double the percentage of the middle 50% and many, many times that of the lowest income brackets. And with a bull market that started in 2009 and continued into the first part of 2020, with all the major indexes, the S&P 500, the Dow, the NASDAQ, reaching new all-time highs, this is one of the reasons for the widening wealth gap in the U.S. The tremendous gains that we've seen in the markets over the last several years have really benefited only one group in our country, those that are very well off, which leaves many of us in the dust to pick up the crumbs here and there. Now, one of the most common goals of investing, of saving, is to prepare for that day when you're no longer going to be active in the workforce, that next chapter in life called retirement. And with this long-term planning, whether you're thinking of retirement, whether you're planning for other long-term goals, whether you're accumulating wealth, whether you're trying to leave a legacy to your children, perhaps to your community, with all of this, the original concept of long-term planning, sort of post-World War II, used a metaphor called the three-legged stool. Now, some people have attributed this sort of illustrative way to look at long-term planning to Franklin Roosevelt. Others think it originally came from an illustration back in the late 1940s by an insurance company. There really doesn't seem to be any definitive proof of its origin, interestingly enough, but we still use it. And the original three-legged stool was consisting of one part Social Security, one part after-tax savings, and one part pension. And over the years, the pension segment has been largely replaced by 401k plans, 403b plans, SEP, simple IRAs, and so forth. Currently, less than 20% of the Fortune 500 companies even offer traditional pensions. They're even less common in smaller companies. Oh, you might still find pensions at perhaps jobs involving the government or where there's a labor union involved. But the good news is that at least 75% of the companies out there will offer some form of retirement savings plan, and a lot of them will contribute some form of a matching amount to it. Now, another issue that affects the concept of long-term planning, is the fact that less Americans are working at traditional employer-employee jobs. Statistically, we're reaching the point where more than half of all Americans will no longer be traditional employees. They will be working as contract workers or, really more correctly, solo entrepreneurs. The author Daniel Pink, in his 2001 book, Free Agent Nation, really foresaw this happening. And the net effect of this is it makes the individual even more responsible for retirement savings, because when we look back at the three-legged stool, we see that Social Security's still there, But if you're working for yourself, you're paying in both sides to Social Security, the employer and the employee side. Private savings are much the same as always. You're kind of on your own with what you do that in your own systems that you set up for that. And with retirement savings in the free agent nation area, we're responsible. We're responsible for them. And when we look at these figures, whether it be retirement savings or private savings, the figures are pretty grim. Now I'm going to put up a couple charts here. You'll see them side by side. The first one, we have sort of a strict definition of retirement savings. These are tax-deferred accounts. And the two columns of numbers here, which are relating to different age groups, represent the average account size and represents the median account size. And really pay a lot of attention to the median figure. We're going to talk about that here in a moment. But when we get to people in their early 30s, 30 to 34, we see that the average account's about $24,000, but the median number is about $700. 35 to 39, we're up close to 45,000, average account 2,600 median. When we're in our early 40s, we average out about 68,000 with only 8,000 median. 45 to 49, we're 119,000, 12,000 median. 50 to 54, the average jumps up to about 138,000. Interestingly, the median drops down to 11,000. From 55 to 59, we've got about 212,000 in an average account, and about 15,000 is the median number for these accounts. And finally, the years that are looked at most often as the ones just prior to retirement, the retirement account, an average one, has about 229,000 in it. The median account is 16. Now, when we go to our other columns of numbers, we're adding in the private savings. So what we're doing here is we're taking two legs of the retirement stool. The first set of numbers looked at only one leg, the retirement savings. Now we're going to add in another leg, the private savings. So two of them combined here. And when we're in our early 30s, we see an average account of about 43,000 with a median of 6,500. 35 to 39, we're closing in on 100 grand, but only 8,000 in median. 40 to 44, 128 average, 15 median. 45 to 49, 230,000 in the average account, 20,900 is the median. 50 to 54, we're at 319 in an average account, 22 as a median number. Late 50s, 55 to 59, we're closing in on 500,000 in average account size, 34,000 as a median number. And finally, that critical 60 to 64 age group, we're at 546,000 average, 39,000 median. Now, why are we paying more attention to the median figure? Well, recall the definition of these two ways of calculating. An average is where we take all the accounts together, add up all of the balances, and divide it by the number of people. The median means we have equal numbers of persons below and above the number. So when we're looking at our columns here, we have a huge disparity between the average and the median. What does this mean? This means there's a few persons doing really well whose large numbers are pulling up the average. Because if you have a few people that have really huge size accounts, they can skew the average number so it looks really good. But in reality, when we look at the median number, half of the people are below that. And what does this jive with? This jives with the overall trend towards greater income and wealth disparity in the United States over the past 40 or 50 years. And we're saving less. Most of us don't even have enough savings to cover a small emergency, much less tucking away something towards our future plans, buying a house, investing, looking towards retirement. So again, if we just separated out that third leg of our retirement stool, that's a pretty weak one as well. I've got some statistics here up on the slide that show some recent numbers on private savings, and they're pretty shocking. 39% of us have nothing. We don't save anything, have nothing saved. 18% have something, but it's less than $1,000. So almost, actually more than half of the American population has less than $1,000 saved. 12% manage to scrape up somewhere between 1,000 and just under 5. 6% get between 5 and just under 10. And only a quarter of us manage to have more than $10,000 in private savings. The key to overcoming these trends is simple: financial literacy. Now, during our childhood years, we're often mesmerized with rags to riches fairy tales. As we grow older, many of us still hold on to these fantasies, ranging from dreams of a windfall inheritance from a long-lost relative to, fantasies about winning the lottery. Yeah, both happen, but neither are really the norm. And logically, on a very deep level, we know the reliable path to accumulating wealth focuses not simply on luck, but also on a great deal of perseverance, risk-taking, hard work. But it's difficult for anyone not to be hypnotized by the lure of easy money, and trading certainly may qualify as that for some who look at it from the outside. Because trading securities is a profession in which the lure of wealth is depicted as an attainable reality for the average Joe on the street. And I would wager a bet there isn't a single person that enters that field who isn't attracted by promise of financial independence that the markets offer. Not only can you create wealth, but you can create it on your own, not being beholden to any boss, to any job, to any supervisor. And we've got lots of stories of men and women who beat the odds and they grow portfolios, allowing them to live lives to which most of us really only dream. Unfortunately, there's nightmares made overnight as well. Fortunes can be made and lost every day in the markets. But nevertheless, the truth is that the financial markets are one of the few places where wealth can be made and lost, regardless of the background of the individual. You can do it regardless of where you came from, where you used to live, how much you start with. Just about anybody can save up a little bit of money to open a small trading account, and with some leverage, turn it into a small but maybe growing fortune if they do it in the right way, become educated, and create systems and plans. Is a bit of luck necessary? Well, the harder and smarter you work, the luckier you usually get. Now, the advent of the internet has helped a lot. There's unlimited access to information, unlimited access to tools. You don't have to call your broker anymore to execute a trade. You can do it yourself. Computer, tablet, even smartphone. Some people trade on their phones. You can access everything you need with the right electronic devices, a high-speed internet connection, and a brokerage account. Now, Ann's particular trading room has 3 computers, I believe 4 monitors, and she's on her phone as well. And I've seen others where there's a wall of monitors. Of course, on her monitors, Ann has many windows open that she cycles back and forth between the two. So there's a lot of ease in entering this profession now with the internet. There's not a lot of barriers. And this can be a blessing or a curse. A blessing if you have a trading plan and a system, and a curse if you don't. Again, because the entry to this realm is tantalizingly easy. Moreover, all traders or investors, regardless of experience, should create a trading plan. But if you took the time to ask 100 traders, put 100 traders in a room, or contact 100 traders by email and ask all of them if they would send you a copy of their written strategies, their written trading plan, we'd guarantee you'd experience a high rate of rejection, puzzled replies, or even derision. Ask 100 investors, not even traders, just people who invest, and I think you'd even get a sparser response rate. Ask business owners if they have a business plan, and most are going to say, yeah, of course I do. Yet trading, which is a business, is rife with people that never take the time to draft a blueprint for how they conduct what they do every day in their trading business. And as with most things in business, it's not always about how hard you work, it's about knowing the right things to do and putting the knowledge in play. Working smart instead of hard goes a long way in helping you move forward in trading, as it does in life, really. Making money in the markets isn't so hard when you apply skills essential to converting the power of your knowledge into profits, and that's planning. That said, obviously, there's a lot of education that goes into becoming a successful trader. And Ann will tell you that the years she spent as an institutional trader, even though she had a wide and deep pool of knowledge, didn't adequately prepare her to be a self-directed individual trader. Totally different ballgame. And there was months, if not years of education, and she will tell you she's not done learning. In fact, she'll never be done learning. Because a lot of studies, from the casual ones to those that are in peer-reviewed professional journals, they all reveal remarkable statistics relating to goal setting and success. The overwhelming majority of us don't set goals. And of those who set goals, fewer still commit them to some permanent form, such as a writing of some kind. But those who have goals are up to 10 times more successful than those without them, and those with written goals enjoy triple the results than those with unwritten goals. Think about this. If you simply have goals in your head, you're 10 times more successful than if you never even thought to have goals. And if you take those goals and write them down, you've now tripled your chance of success with having unwritten goals. So clearly a person is more likely to achieve success if she sets goals and ramps those odds higher by writing those goals down. Your trading plan should have your goals. It should commit them to writing, and it should command your constant attention to keep it dynamic and alive. You should give your trading plan the same attention that you give other high priority areas of your life. Traders who carefully plan have a much higher chance and a much greater success rate than those that don't. It's very simple. The simple act of drafting a plan will significantly increase the odds that any given trade you make on any given day will be profitable. And a successful trading plan doesn't have to be complicated. A lot of people put their trading plans in a notebook or on index cards or an easel with paper. Sometimes the papers, large sheets, even have the stickies on the back that you can stick it to the wall. Others are more sophisticated. They use software programs, spreadsheets. Regardless of what method you choose, whether you want to be high-tech or low, every trading plan has to have certain components to be effective. And we're going to walk you through some of those over the next few sessions of this masterclass. And your plan should also be a living, breathing document. Now, creating a successful trading plan is really a three-step process. First, you have to adopt the mindset of a successful trader. This is a key, an absolute key, but it's often overlooked. It's a foundational element to trading. You can have all the education, all the technical skills, but if you don't have the mindset, your trading will fail. You must understand your emotional makeup and the energetic levels at which you function throughout the day and throughout your life to achieve an optimal balance between trading and other areas of your life. We'll see in our next session, Anne is a big believer in how the energetic levels at which you function, and they will change throughout the day, is a key element as well in your trading mindset. So that's the first step. You've got to adopt that mindset of a successful trader. Second, you need some of the basics. What kind of instruments are you going to trade? What platform are you going to use? Where are you going to trade? What hours are available for you to do this? You need to go through and look at, again, some of the basic elements that will be incorporated into the very organized plan that you set up. And third, you need hard and fast rules. You need to have your own maxims that you set down so that trading becomes an exercise in your skill and in following your rules rather than a roller coaster flush of emotion, or worse yet, a casino-like roll of the dice. And you need to know how you can set up your rules so that they become automatic for you. Think about it. A musician performs best when his fingers press the right keys without having to consciously think of it. This occurs through practice, preparation, attitude, and finally mastery. For those of you who know me, you know I'm a musician, and it took many years of practice and preparation for me to master my craft. And honestly, if I thought about the music I was playing, I'd be totally lost. It really operates on a different level of consciousness. And trading, it's both art and science. It's really got to be looked as a combination of both, and it's got to be viewed as such. And again, we're going to lead you through all three of these steps to help you hopefully go on the way towards mastering this craft. Now let's look a little deeper into what makes for a successful trading plan. Well, a trading plan is a complete set of rules, and it's going to cover every aspect of your trading life. Now, many amateur traders and investors don't have any sort of plan, and they enter the markets really with little regard to their risk and profit objectives. Comprehensive risk and money management strategies are the heart of all good trading plans. In fact, one of the definitions of a successful trader is that he or she is a risk manager. A risk manager. If you change your mindset to thinking of yourself as more of a risk manager than a gambler, for example, your mindset will instantly shift to a different perspective. And from a good plan comes solid, fine-tuned habits. Keep in mind, bad habits are really easy to create, but they're difficult to live with. Good habits are difficult to create, but they're very easy to live with. And so a solid trading plan is going to help you create and maintain good habits. Traders with a plan have the ability to monitor their performance by evaluating their progress continuously, day by day, in a way that's very objective and comprehensive. You know, because you're looking at numbers on a screen, whether you followed your strategy, whether you followed your plan, and if you followed your plan and the trade was successful or not. As long as you're following your plan, it'll enable you to invest without emotion and with less stress. Conversely, if you have a trader that doesn't have a plan, he or she's not able to do this. Many of these folks rely purely upon gut feelings. And although Anne will tell you you should pay attention to your intuition, you need not rely on hunches or tips. For those folks without plans and are relying on those things, trading is really nail-biting. It's an emotional roller coaster ride of enormous stress. And oftentimes results in you just blowing your account up. Now, obviously, a trading plan doesn't guarantee success. That's too simple. If that were the case, everybody'd have one, and we know that's not the case. But a good plan that is adhered to strictly will help minimize your losses and enable you to stay in the game successfully and a lot longer than traders that don't have a plan. I mean, your plan can't predict the future, but it can help you stay on track when facing possible outcomes and respond instead of react. This is why a plan is essential. It's a list of strategic responses to events that are likely beyond your control. Once you click buy or click sell, there's nothing more you can do. You can only control one thing, and that's you. Now, confusion exists over the difference between a trading plan and a trading strategy. A trading plan is a complete set of rules that governs every aspect of your trading life. It can go into great detail and may, for example, even address the amount of time devoted to reading, research, and other trading activities. A trading strategy is used to describe entry and exit criteria, and these are elements of an overall trading plan, and it's perfectly feasible, sometimes even desirable, to have two or more trading strategies within one overall trading plan. Even if you have been a consistently profitable investor or trader over a long period of time, throughout a number of different market conditions, or you've had someone else manage your money, you still need an investing or trading plan. Even if you have already achieved and done well, or have that person on board, this course may still provide a useful refresher to you, or indeed open your eyes to new aspects of trading that can improve your profitability. Because a trading plan is a roadmap. It's quite literally the route that will take you from where you are now to where you want to be, which for most traders is consistent profitability. It doesn't mean you're going to win on every trade. It means you're going to win on enough of them so that it covers your losses and then some. But to begin trading without a clear idea of where you're going and how you're going to get there is almost certainly going to result in increased stress, sleepless nights, financial loss, or all three of these things. A trading plan is going to make the act of trading simpler than it would be if you traded without one. It's going to limit your opportunity to make bad trades, and it'll prevent a lot of psychological issues from taking root. Again, one of the things that sabotages most traders is their mindset. It's going to also help you to achieve these things because wherever you are in your trading journey, it's not only going to act as a roadmap, but it also tells you where you are at any given time. And if your investing or your trading is going well or it isn't going so well, you'll know it's due to one of two things. Either something in your trading plan is working really well or it isn't working, or you're not adhering to the plan or you are. Now, if your plan's a good one, it's back-tested and paper-traded or maybe even forward-tested with a very small amount of money, then the fault is likely to be found in the fact that you're not adhering to your plan. If you're losing money while investing or trading without a plan, it's impossible to distinguish what you're doing right from what you're doing wrong. You could be lucky on the days you made a profit and have no clue as to why you made a loss. You don't have any way to evaluate your results. Therefore, the likelihood of being able to diagnose the fault and correct it and make it better next time is small. Again, a trading plan is kind of your personal GPS. It locates where you are if you've made a wrong turn. It provides a way for you to identify where you went wrong and how to get back on track. You can continuously evaluate your results and, more importantly, your discipline in sticking to your plan in a manner that is objective, comprehensive, and free of emotion, detached from results at times. This is an extremely difficult thing to do if you don't have a plan. And your plan should take away much of the decision-making that you might need to be making in the heat of the moment. Emotional issues will become very powerful when your real money is on the line. And, likely as not, it may force you into making irrational decisions. But if you have an effective plan, your every action should be spelled out, so that in the heat of the moment, you really aren't making any decisions. You're simply following what your plan is stipulating. You are responding instead of reacting. Now, we hope in this introduction here, you're totally sold on the merits of having a detailed and clearly laid out investing plan. In case you're still in need of convincing, let me summarize here the key benefits. It's going to allow you to trade in a more relaxed, a more low-stress way. It's simpler with a plan than without one to keep your lifestyle more relaxed, less stressful. A plan allows you to monitor your progress, diagnose faults, amend your plan accordingly. A plan will help prevent many psychological issues from taking root as those bad habits, which are very difficult to get rid of. Strict adherence to your plan will reduce the number of bad trades that you make, and it will help you in preventing irrational decisions in the heat of the moment, enabling you to control the only thing you can do once you click buy or sell, and that's yourself. Professional traders are very highly disciplined individuals. A plan, perhaps together with some of the resources, other resources that are available through you through the A Wealth School and the mastermind groups that Ann runs, will instill a large measure of discipline into your trading. A trading plan will allow you to discern the difference between trading and gambling. Gamblers tend to lack both discipline and a plan and are more engaged emotionally in what they do. It'll enable you, this plan, a trading plan, will enable you to trade outside your comfort zone. How many times have you let a loss run and cut a profit short because it was the comfortable thing to do? A trading plan executed with precision and with discipline will help to prevent this from happening. And a trading plan will give you your roadmap, which will enable you to get from wherever you are now to where you want to be, which is, for most traders, consistent profitability. It enables you to connect with your goals, the ones you've written down, and your dreams by challenging you to question your beliefs and your values. If you do take a wrong turn on the roadmap, you'll know about it really quickly, and you'll have the opportunity to correct the problem before losses spiral out of control, and again, you blow up your account. Now, before you start to create your own trading plan, here's a few pointers to help ensure that you build the best plan possible. Why do you want to trade or invest? Do you want to make money from the comfort of your home, be your own boss, beat the market, build real wealth? It's tempting. One of the many valuable questions to ask yourself is whether you have the intestinal fortitude to face the market every morning or on those days in which you want to engage in your trading. Why trade? Well, to make money is the generic answer. That's applicable to everybody, right? You'd be a rare trader if you traded securities with the goal of losing money. But making money is not personal nor specific, and therefore it's not helpful to your plan. It's not measurable in time or dollars, and it's useless as a goal. Trading is a business, and as such, it requires attainable and reasonable goals that can be tracked. Trading demands that you possess the right temperament. It can make a difference in your life and the lives around you. That difference can bring satisfaction or misery. So begin by asking yourself whether this is something you'll enjoy doing. One of the things I did for several years together with Ann is we both traded. And although I had, I think, a fairly good track record and was successful at it, I didn't enjoy it. Honestly, it was not something I looked forward to getting up every day and doing, as opposed to Ann, who lives and breathes it. So if it isn't something you enjoy doing, stop. Do something else. Get a job. Let somebody else handle your money for you. Think about it. You may like bagels, but the chances are you would not dream of buying a bagel shop and going to work there every day. Why become a trader if you wake up every morning dreading your day? Maybe you've seen folks on Bloomberg or CNBC and thought to yourself, I love to be that passionate about what I do. So you may have a need for excitement. Now, ordinarily, such a desire is an admirable one, but in the markets, it could easily lead to catastrophe if it's unchecked. Because unbridled enthusiasm can lead to emotional decision-making, which is a disaster in the world of securities. Maybe you've heard those stories about traders making tens of thousands of dollars in a day. You know, some do. They're really only a small fraction of the traders. And there's only a certain fraction of traders, or those who try trading, who make money at all in the markets. Crushing disappointment is often the reward for rampant greed, pie-in-the-sky fantasies about trading on a laptop aboard your luxury lot as you sip champagne cruising around the Bahamas. Well, it's great fun, but they're not really grounded in reality. They may help you motivate you to study the markets, but the emotions that accompany them won't be your friend when it comes to actually trading the markets. Like a trader with lust for excitement is doomed to fail. And the fate of a trader motivated by greed is really going down the same path. And having these thoughts and emotions isn't the problem. It's how you control them while you are trading that is issue. A fantastic resource that Ann highly recommends for mastering the market with the confidence, discipline, and necessary winning attitude is the book Trading in the Zone by Mark Douglas. Again, Ann highly recommends this text. Now, the first step in freeing yourself from the vagaries of greed and fear is to understand your own personality. Now, each of you should have a workbook that was emailed to you. There's an exercise, the first one in that workbook. It's really a set of questions, I believe there are 30 of them, that looks at and assesses sort of your trading mindset. And a deep dive will be in order after that, but if you complete the exercises, especially before our next session, that's going to help you as we look forward into the trading mindset. And that's what our next session is all about. It's going to be all about the trading mindset and Ann's views on the levels of energy, how it impacts that, and how different types of obstacles can get in the way of trading success. So again, in the workbook, there is that first set of 30 questions. It's an assessment. It'd be best if you did that. Don't think too much. Put the first answer down that comes to mind, and try not to look ahead in the workbook before you do that first assessment, those 30 questions. And our next session is tomorrow, same time, 4:15 p.m., right after the closing bell. Gives you a few minutes there to grab something to drink and take a little moment to breathe after the markets have closed. And we will dive into the topic of mindset tomorrow, and we will see you all then. Until then, have a great evening. See you all tomorrow.